Welcome. Good morning, everybody. Strong rally across Asia as markets track the historic Wall Street session. That turnaround, a historic turnaround after President Trump hit pause on tariffs for dozens of countries in a dramatic reversal. But President Trump ramped up tariffs on China to 125% after Beijing retaliated with 84% tariffs in a dramatic escalation, even as the US president holds out for a deal with Beijing. And India hoping to conclude a trade deal with the United States, but also looks to close a trade agreement with the UK. So some staggering and some extraordinary volatility in these global markets. Let's take a look at the Asian markets, which are bouncing back and steady after that tariff timeout for 90 days by President Trump. So this really has changed the narrative, and one has to wonder what is going to happen within that 90-day time frame to change the narrative even further and create more volatility. And of course, the big gorilla in the room is that 125% headline tariff on China still, and China looking to retaliate and putting countermeasures off its own at 84%. So Trump's 90-day pause on reciprocal tariffs buying some time for countries to negotiate deals. Japan, South Korea, Vietnam and India are doing just that right now. And we are also keeping a close eye on US equity futures after that dramatic session overnight. And we are looking for any evidence of a continuation in that monster historic rally, but it looks as if markets are still in a distinctly cautious frame of mind, judging by the equities picture. And it goes back to the point that we've been making throughout the programme. There is still this deep, deep animus between US and China, and China not escaping in terms of any kind of 90-day retrieve. In fact, we are seeing the contrary, an escalation. Right, we are coming off a historic session on Wall Street, as we've been reporting throughout the day. The Dow soaring nearly 3,000 points. We haven't seen this kind of volatility since the pandemic crisis, and its biggest point gain ever. The S&P 500 had its best day since 2008, and the Nasdaq up a massive 12% for its best day since 2001. We should note, as you can see there, that the US markets are still in negative territory so far this year. Treasuries, which were a major pressure point, also moderating, the very long end of the curve backing off 5%. Let's take a look at the 30-year, and it's standing at 4.6852 at the moment. The benchmark 10-year at 4.2793. Firm demand at a closely watched 10-year bond auction also helped to provide some breathing room. Now, the major turnaround in markets coming after President Trump said he would temporarily reverse tariffs because he noted people were getting, quote, a little afraid of tariffs, and after Jamie Dimon's recession warning in an interview on Fox News. The moves were nothing short of stunning in a dramatic 24 hours. This is where things stand as of now. Trump has hit the pause button on tariffs for dozens of countries for 90 days, temporarily lowering them, keeping just the 10% base for all, however. But he ramped up the levies on China to 125%. This is hours after Beijing retaliated to Trump's 104% tariff with an 84% rate on US goods. Trump also saying he thinks 125% is the peak, and he doesn't think it will need to go any higher than that, as he still holds out for a deal with China.
China wants to make a deal. They just don't know how quite to go about it. You know, it's one of those things they don't know how quite. They're proud people. And President Xi's a proud man. I know him very well, and they don't know quite how to go about it, but they'll figure it out. They're in the process of figuring it out, but they want to make a deal.
Let's go straight to Emily Tan now in Hong Kong, who's been tracking all the China reaction and joins us now. Good morning, Emily.
Hi there, Sri. And we did get a chance to hear from the Commerce Ministry earlier this morning, and in their response saying that they are willing to resolve differences through consultation and negotiation, and that China will fight to the end. So this response has been the same all along in all of the different various stages of the tariffs being imposed. And with that now, earlier today, we heard from President Trump, 125% on China effective immediately. And this comes as Beijing's reciprocal 84% tariff going into effect today. Now, we are watching the markets here, and a big rebound that is playing out across the Greater China markets. Shanghai higher for 1.1%, Shenzhen up 2.75%. The CSI 300 traded at 3,700 thereabouts. We are tracking, of course, the gains that are coming through here. We're tracking some of the logistics plays as this kind of pause that Trump has put on the rest of the world puts back into play the China Plus One strategy. So these logistics companies could be still at work. With Vietnam getting a deal, of course, with the United States, it could be a sign that exporters can survive. There's going to be a rerouting, if you will, and the motivation to do that. So some of the logistics plays in the Hong Kong market, like ZTO Express, higher by 8%. We have SF Holdings shares better for 3%. We are tracking, of course, the impact and some of the economic data points coming through from China. CPI this morning, we're watching that for the month down 0.1% on year. PPI was down 2.5%. We are going to be watching, of course, how China is going to be grappling with the risk of deflation. There is sluggish demand as well as overcapacity. And the fact is that as the demand from America declines, how the glut of inventory that China is manufacturing, how that is going to be consumed, whether or not it's going to be, of course, shown up in prices in China. We're watching the CNY as well, a 7.3585 for the CNH last traded. And of course, there has been some market speculation as to whether or not the authorities in China will devalue the yuan as a way, of course, to not counter the tariffs, but of course to take on the tariff threats. I did get a chance to speak to Stephen Roach this morning from Yale University, and in response to him the questions, of course, I was asking about China fighting to the end. He's saying that this is not just a slogan. He believes it's deeply anchored in the political commitment that China has made in the form of what Xi Jinping has called the Chinese dream. He says, in terms of President Trump, that he has now flinched. He has showed and laid his cards on the table, showing us that he will flinch and flinch once again as the markets put pressure on him. He could intensify his pressures on China. He could relax them, but nobody knows what he's going to be doing next. And this, as Stephen Roach and I likened to what's happening to a poker game. And of course, we'll see if China really will ante up to 125%. It remains to be seen. Sri, it's back to you.
You raised some key themes there to look forward to, including what happens with the currency. Are we going to see further attempts by the leadership in Beijing to engineer a weaker currency? And then, of course, what happens to that excess capacity now that the US market is essentially blocked off for China? And that has implications for the regional markets and the economies over here in Southeast Asia especially. Emily, thank you very much indeed for that. Let's return to India. And markets are closed today for a holiday, but look at how some of the Indian-related ETFs performed in the US market, seeing green across the board after President Trump's U-turn on tariffs. Dow Jones India ADR GDR index also ending the session on a positive note. Let's take a look at the Indian rupee while we are at it, and the dollar rupee rate standing at 86.2060. Remember, the RBI yesterday elected to cut the benchmark repo rate by 25 basis points. And of course, there appeared to be a commitment and a willingness to do more. But in the here and now, they didn't go for 50, keeping their powder dry. In the meantime, as India speeds up its tariff negotiations with the United States, it's also looking to boost its trade partnerships elsewhere. Indian Finance Minister Nirmala Sitharaman was in London to meet her British counterpart Rachel Reeves, the Chancellor, two sides close to securing a bilateral trade agreement.
I'm certain that the insights gained by each side during this session will help in strengthening and regulatory and in strengthening the regulatory bridge that we have established via this annual dialogue and help enhance capacity building, knowledge sharing, and investments.
Right. I'm delighted to say Mathieu Borteau is with us now, portfolio manager at Fiera Capital. Mathieu, welcome to Inside India. And what an extraordinary setup. And you've been in and out of client meetings in this region. What then should EM positioning, in your opinion, look like, given this extraordinary volatile backdrop?
Yeah, it's first, thank you for having me. And it's true, it's been extremely volatile, and I think from the get-go China has always been the center of focus for every, even global investor. We saw this first rotation from the US Max 7s as soon as DeepSeek came out into European value, and then from European value into China for deep value. The issue is that until now the market would just re-rate on news or noise on stimulus. And now that China is facing the 125% tariffs, I feel like the small relief that they're seeing today is on the hope of a stimulus, but nothing fundamental. Therefore, I think looking at all of the US allies in the region, namely Korea, Japan, even if it's not EM, it's still APEC, or even India or Asia, ASEAN overall, would be those countries benefiting from this already 90-day relief on tariffs. But also I would almost want to see a sort of rally of those troops together and face the China situation with the US and find a compromise there, which is where I think Scott Bessent was directing his whole diplomatic trade war, if you want. Sorry,
yes.
It's a bit of a funny way of turning this, but it is that way. The US has always wanted to make trade very fair with the US, and obviously the biggest criminal in that was China. And the way they orchestrated this through these ridiculous tariffs presented to us last week was really to incite all of those players in the region to either come to the negotiating table
yes.
or see who will retaliate. And I feel that unfortunately China has fallen into that trap. All the other allies, saying India or Vietnam or Korea, have all made diplomatic moves to go and talk to the Trump administration. But China has not. So as an EM investor, I would be looking at the rallies in Vietnam, most importantly, which has been limit up this morning, and India tomorrow, but also Korea, who's a massive exporter into the US.
Mathieu, there are so many second-round effects that we have to be cognizant of, not least of all associated with depreciating currencies and excess capacity. But from an overall EM investment vantage point, is this the time to buy China? Excuse me, let me rephrase that. Buy India and sell China?
I think surely India is in an extremely interesting position because they, if you remember, on April 2nd, it was one of the markets that resisted the most. Not only because they had the exemption on pharmaceuticals, but because it is a market that doesn't really export to the US. India has been a major beneficiary of Trump's first administration, being at the center of this China plus one strategy for global manufacturers or companies. What I think I'm seeing there is a more decoupling of this China plus one, because we all knew that China plus one meant 80% China, 1% a bit of a hedge into another country. But here, I think there's going to be a further decoupling, and given how flexible the supply chains are in India and how anti-fragile the economy is, I think India is in a really good position to benefit from this, indeed.
So when you look at a chart like this, this is a picture that could very well turn around, and we could see the shoe on the other foot. But at an aggregate level, as far as India is concerned, Mathieu, you're cautious, but you believe India has the potential to positively surprise in small, niche and isolated pockets. How then would you express that from a portfolio allocation point of view?
It's, I think the main story in India has always been this, the demographic dividend that would trickle down into earnings growth. And it attracted a lot of foreign investors to pump the market into hugely high valuations. And I think the chart you were showing earlier was a sort of profit-taking level where investors rotated into China for value and stopped really believing that India could materialize that dividend, that demographic dividend. Because what is clear is that the capital market story in India is a really transparent one. Companies and entrepreneurs in India have to be transparent because the access to capital is limited. They can't depend on a big government reform or a government push into a sector like China does. And so each leader of industry that emerges is one that will return higher return on capital. And it is these opportunities that we want to see rather than the big market mega caps that people will be piling into for the wider India story, which, in our opinion, does not reflect where the true gems are in the market.
That's interesting because Make in India seems to be a central part of that revival. And what's your take, Matthew, on the policy response so far, whether it's yesterday's RBI 25 basis point cut, the pursuit of a US bilateral, a UK trade deal, wider regional cooperation? Should that give us conviction towards the export sectors that have been hit the hardest, whether it's IT services, pharma or the car makers?
So I think talking about the rates, it's been a long time coming. I think there was a lot of tussle between the government and the RBI over the past months. And now that it actually happened, because growth looked a bit low in India by the end of last year, I think now I would still be cautious on exports, because although I was previously talking about the supply chains being flexible, they are still very sticky, and it will take time to make that move. And as an investor, probably we'd want a bit more certainty in those changes to be signed and materialized before allocating capital. What is interesting in terms of relationships is that India has always, I think it's an opportunity for India to really renegotiate their trading partnerships. India has always been a very good neighbor to have and a very good partner to have. Modi's diplomacy has always been to be a convenient place for international companies to do business in India. But this is the opportunity for them to have a comparative advantage with the infrastructure that they have, with the human capital that they have, to allow companies to come in, but India to actually benefit from it rather than just end up in a trade deal which is a null-sum game.
You like the power generation companies. Is that a bet on the AI boom and a demand for energy, or is it more broader? And are you hanging your hat on the transition towards renewable energy? No, I think coming out of COVID, there was a clear move globally to get rid of fossil fuels and to move into renewables. And the Indian government was at the forefront of this change and wanted to change the energy mix of India to make it less reliant on the fossil fuels and pollution, etc. What we've seen is the government almost sponsoring large projects alongside existing energy companies. And it's in this transition where we find attractive opportunities, where new financing vehicles are being created to support these projects. And also, there's a really reduced risk in those, because as soon as you're allocating capital to projects with incumbent larger companies, then your execution risks go down. AI just came after and added a little cherry on the cake to that investment thesis. But other than that, no, the energy strategy for India is a long-term one and not just dependent on AI. Understood. Matthew, just run us through the risk-reward for niche sectors and the selective areas that you like that are exposed to servicing global supply chains and credit institutions.
Well, I'm actually quite... Let's talk about the credit institutions. The credit institutions is really a play on the exodus of the rural population going into rural areas and coming into formal employment and requiring financial services. This, for us, in terms of microcredits, microfinancing, but also small consumer loans, is an extremely attractive opportunity for us, because the companies that are recruiting these people moving in are here to stay, and they are more geared towards the local economy rather than the exports. And now that we see, even if these could be exporting companies, we see that as a positive because Europe is to the left, if we look at the map, and the US is still there. So we see that growth and we see that migration and requirement for further financial services at this level grow for the next 5-10 years. And I think this is the sub-part of the demographic dividend that India has, which we try to capitalize on. So my risk reward for this is actually quite neutral. I don't think I'm going to off benchmark or off into crazy ideas and very small niche stock picks. This is just a stock or a sector with huge potential that it seems that a lot of international investors are not looking at.
If 6.7% headline growth for India is at risk, how then do we approach the domestic economy stocks from FMCG to the banks? And am I right in saying, Matthew, that your proposition is more focused on small to medium caps as opposed to the big blue chips?
It sounds counterintuitive, but I would say yes, because every time earnings growth for these small and mid caps has always been relatively bigger than the bigger blue chip names, and I think that India has always had a domestically driven economy, and the only export has been sectors, really. Services. Services have been the main driver of the exports and trade balances. But what we're focusing on in terms of domestic is that area where Modi can continue bringing employment and develop supply chains. And what I'm hoping is that rather than depending on those entrepreneurs that are building great businesses in India just by default rather than by design, there is a clear strategy from the private sector and the government to create a reform that will allow further growth domestically to stem from it.
Matthew, we will have to leave it there. Fascinating conversation. Thank you very much indeed for sharing those insights with us. We appreciate it. Matthew Bortold there from Fiera Capital. Right, I want to bring you up to speed with some lines from Ray Dalio. And he says he hopes and expects President Trump to negotiate a trade deal with the Chinese. This is according to Ray Dalio posting on X. Dalio also says the next Trump administration move, what they should do next, should be to deal with the deficit well by cutting the deficit to 3% of GDP. Ray Dalio on Trump's tariff decision says that decision to step back and a timeout, effectively, and negotiate how to deal with imbalances is a much better way. So effectively, Ray Dalio calling for a US trade deal with China. Right, we are back in 2 minutes. Stay with us for more conversations. As we mentioned, India is working on trade deals with multiple countries, with some saying it stands to benefit from higher tariffs on China. Beijing also, on its part, is relying on expanding deals and partnerships with other countries. JP Ong has more and joins us now. JP, it's fascinating, isn't it? Because there's a 3-month, effectively, hiatus now, and I doubt anyone is really going to take that for granted and is going to relax. They're going to be negotiating deals left, right and centre, yes?
Absolutely, Sri. And I think it's not just negotiations with the United States, but with each other. As everyone tries to find new trade deals, new trade opportunities to try and at least diversify away from any impact from additional tariffs. As we know that while there is that 90-day pause, those blanket tariffs of 10% have still come online and will be important for countries like Singapore, which happens to operate one of the 2 busiest ports in the entire world and will be impacted by any trade disruptions or dislocations. We do know that President Xi Jinping of China is heading to Malaysia, actually, starting on next Tuesday next week to discuss bilateral and also economic relations. He's also planning to visit Cambodia and Vietnam in the near future, or in the coming days also, as China itself also tries to at least solidify some of its existing trade relations in this part of the world, where they count China as one of their biggest trading partners. Now, one of the biggest questions, though, also is what this will mean for countries that have been trying to boost their manufacturing base, such as India, for instance, which has been trying to diversify and create more of a manufacturing footprint out in the southern part of the country, if I'm not mistaken. We did speak to Deborah Elms of the Heinrich Foundation, and she does think that there is one other challenge that might come online, because these Chinese products will get affected by the tariffs. We'll have to find other markets, and will create challenges for certain regions like the EU and the broader Asia. This is what she meant.
Especially when you have 125% or higher tariffs on Chinese goods, those goods are going to go somewhere. And as those goods pivot to find new market opportunities, we will find competition rising in other places, including, again, the European Union, much of Asia, et cetera. That's going to put pressure on politicians in particular to stand tough against what will feel like an incredible tsunami.
And just to bring you a small anecdote, actually, from Southeast Asia, Sri, leading up to the tariffs, actually, we saw a number of factories, textile factories in Indonesia actually closed because of economic uncertainty, and that has been ratcheted up by the tariffs. So it's something to watch out for countries like India, for instance, that are also trying to bolster their manufacturing base because of the new challenges posed by the new tariffs that will be on a 90-day pause, but emphasis on pause, sir.
I'm really glad you mentioned that, because MNCs, US MNCs, have big exposure to manufacturing in Southeast Asia. Everyone from Nike, Calvin Klein, Ralph Lauren, etc. Huge implications there, JP. Thank you. We're going to talk about supply chains and how Sri Lanka fits in and de-risking those supply chains after the break. Welcome back to Inside India. Worries are mounting on the impact of tariffs with global supply chains under threat. However, some find India more insulated compared to other countries. JP Morgan's James Sullivan was on Squawk Box this morning. Here's a slice of what he said about where India stands amid the tariff risks.
I think we also have to be cognizant that the structure of trade from India to the United States is very different than, let's say, China as an example, because of the services component. And the one aspect that we haven't spent a lot of time talking about is the fact that the U.S. administration is almost entirely focused on trade in goods, not trade in services, where the U.S. actually has a surplus. If that narrative starts to shift, we have to recognize that the large majority of Indian exports to the United States are IT services. Those stocks have taken a significant hit due to the risk of recession in the United States and the lack of corporate expenditure that would then hit the IT services top line. But it's really the nature of goods versus services, India versus China, that we're very focused on.
Some companies are also seeking India as an option to mitigate the tariff impact. One such, a Sri Lanka-based company, Bratex, is eyeing more clients in India. Sri Lanka was among the highest tariff bracket imposed by President Trump. There's no clarity if the 44% tariff is on the negotiating table yet. Reports say US clients of a number of Sri Lankan firms have asked them to keep the shipments on hold. Let's bring in Joe Diesel now, the Managing Director of Bratex PVT Limited, and joins us now from Hong Kong. Joe, thank you very much indeed for your time. So President Trump's 90-day timeout on reciprocal tariffs includes 44% on Sri Lankan imports, although the 10% base still remains. What does this mean for your business and customers? And I would imagine you will be using the next 3 months to diversify the client base and de-risk the supply chain, yes?
That is certainly correct. Let me just first say that I've never been more relieved to receive a customer text at 2:30 in the morning telling us the 44% was on hold. 10% is still substantial in our industry. I'm sure you've had numerous guests talk about how we are on very thin margins in general. However, 10% is better than 44%. The last week has been kind of tumultuous. After the initial shock was over, we thought it was going to the so-called dirty 15. We just started actively talking to our customers, what they're seeing, what their plans are, what they hope to achieve, trying to rationalize some product in the marketplace where we have room, and just keeping open lines of communication, both up the supply chain and down the supply chain to our suppliers. Most people had a fairly resigned reaction, and now I think is next 90 days, next 3 months is when the real work's going to start. Yes. Shipments seem to be back on as of this morning, which of course is a great relief to everybody, especially because we're coming up to Sri Lankan New Year and everyone's trying to get goods out. Hopefully everybody's cash flows will be okay. And next, it's up to the negotiating teams.
Joe, is there any tariff? We're well aware of the tariff differential that India enjoys on a relative basis, and all of this is relative, isn't it? Is there any tariff differential arbitrage that can be gained from shifting some manufacturing, Joe, across the Palk Strait into India, into Tamil Nadu, perhaps?
Yes, there certainly can be. There's a 10-12% spread. That's not something I think most manufacturers are looking at immediately for the U.S. market at this moment. I think that's something that can be considered as more of a long-term plan if the next 90 days things don't work out in everybody's favor, simply because there's cost involved in that. There's cost involved to that. We've already seen in the last year or two a lot of manufacturing just shift to India generally, but I think Sri Lanka enjoys a very good reputation, both in garment quality and in ethics and sustainability and CSR, and a very high CSR record. So most of our relationships are based on that and the quality. So just randomly seeing expertise move to India, I don't think is going to happen in the near term.
Joe, you said that the entire industry is operating on very thin margins. And let me take the worst case scenario. If 44% tariffs stay after 90 days, then to what extent does manufacturing in Sri Lanka become unprofitable, become unviable, and you are forced to reconsider your investment there altogether?
Oh, it's 100% unviable. And most manufacturers, there's some guys who are, some facilities who are already talking, have contingency plans. Again, this is anecdotal on closing down straight away. These are guys who have 80% exposure to the States, 90% States. So it will be a tremendous loss, especially at a time when, the country is also recovering from a financial crisis from 2 years ago. A lot of, I think, the taxes and I think what the U.S. perceives as shadow duties, let's call them, and placed on incoming goods are also hoping to recoup some more revenue for the government that has previously been very free and open to imports.
Joe, not many are aware outside our immediate region, but the big apparel names from Nike, Victoria's Secret, Calvin Klein, Ralph Lauren, they manufacture in Sri Lanka, Vietnam, Southeast Asia. Do you have any idea why the Trump administration has put all that now in direct jeopardy?
I think that's the billion-dollar question, isn't it? Just around the region, I don't perceive the U.S., and being able to draw back a lot of manufacturing into the States, especially in the garment sector. Something like phones, high-value items, cars, perhaps, something like garment manufacturing, it's just too labor-intensive at the moment. If you look at Bangladesh, I was reading yesterday, there's 4 million people directly employed or directly or indirectly employed in the Bangladeshi garment sector. Like you're not going to be able to replace that in the States just with the volume of people and also the training. Right now, especially in Sri Lanka, we have very skilled workers who've been doing it for a very long time.
Yes.
It takes time, pride in your work, and it's not something that you can switch on and off.
And that's where the value proposition lies, in that quality. Bratex is a family business, Joe, and you're very proud of that, spanning 3 generations. You've seen, I'm sure, some very challenging cycles, not least of all recently Sri Lanka's own economic crisis back in 22. How have you ridden out these shocks? And are you confident, and how confident are you that you will survive this one?
Yeah, how we've ridden it out is basically by being loyal to both our own employees and to our customers. We've always enjoyed good relationships with our customers and down the line, good relationships with our employees. So taking a family-first approach, we've always called it the Bratex family, not the Bratex company internally. We've managed to keep that loyalty. Everybody has to try a little harder. Sri Lanka has always amazed me with its resilience, and nobody really has an attitude of just wanting to get out of there, use it for a couple of years, get out of there. Most of the guys investing in Sri Lanka are there for the relatively long run.
Joe, as we've been discussing, my family origins go back to Sri Lanka, and I wish you and the Bratex family all the best, and I hope that we all get through this. Joe Diesel there from Bratex PVT Limited. Thank you very much indeed for those insights, Joe. Right, shifting focus to the Middle East, Dan Murphy is joining us now from Abu Dhabi. Dan, tell us what you're covering on Access Middle East today, and just how strong do you think that extraordinary turnaround is going to be manifested in your markets?
Hey there, Sri. Good morning to you. Well, we are, of course, following the market reaction to Trump's tariff turnaround. I'm going to have the latest on what that history-making session on Wall Street means for markets with Sadiq Hussain. He's the boss at Seviora. That's Temasek's wholly owned subsidiary that just opened an office here in Abu Dhabi. So we'll unpack the strategy and ask him what makes it unique. I'm also speaking to Lebanon's former economy minister about the regional economic state of play this morning as well. So do not miss it. Access Middle East starts at the top of the hour. Sri?
Dan, fantastic. Thank you very much indeed for that. Coming up on the programme on Inside India, we will look at the tariff story from the lens of the Indian consumer. Is this going to impact spending power in India? Harsh Maniwala, MD and founder of Marico, one of India's largest FMCG companies, joins us after this break. Do stay with us on Inside India. Welcome back, everybody, to Inside India, and we are focusing on the consumption story today. It's the consumers that back India's growth. Consumption makes for 60% of the country's $4 trillion economy. However, there were signs of weakness in spending power and confidence, and rising inflation. Stagnant wages have hit the consumer hard, and volatility from Trump's tariffs could further damage the spending growth. Let's check what businesses are feeling about it. Harsh Maniwala is MD and founder of Marico. It's one of the top 10 FMCG companies in India with a presence in 25 countries. Harsh, thank you very much indeed for joining us on Inside India. First of all, how would you characterize consumer and business sentiment right now?
So as you rightly put it, in the last few years, the consumption has gone down in terms of growth rates. For the last year, we saw a growth rate of 4.3%. And India is a large country, so if you divide India between urban and rural, urban was growing at 2.5% and rural grew by about 6.9%. So the rural is doing better than urban, but still the growth rates are very, very low compared to India's potential. India's penetration in terms of the categories where the usage is happening, and also compared to the past growth rates. So it's a bit worrying. And again, if you divide between foods and non-foods, non-foods is going by about 6% and foods is going by about around 4% or so.
Harsh, we have a reprieve, a 90-day tariff timeout, and India benefits from that. But do you fear, given this extraordinary backdrop and a conversation and a non-trivial risk about stagflation as well, that inflation could resurface in the Indian economy? It has stabilised now. And to what degree does that reignite a cost of living crisis? And where does that leave the pricing environment for Marico?
So I personally think that the inflation, because of the Trump action, may not increase much. Actually, the crude oil prices have fallen, and if they continue at like this, it will be beneficial to the consumer. So overall, I am not worried about inflation, but the larger impact of all the actions which he has suggested he'll do. Now it's got deferred by 90 days and again subject to trade negotiations. So we still don't have a clear picture in terms of what's going to happen ultimately. But nonetheless, even if the tariffs are imposed as suggested earlier, the impact on India is not going to be that large because India exports more services than goods. So I think that plays a very important role. And India's relative import duties compared to many other countries like Bangladesh, Vietnam, and many others are lower. So I think from that point of view, we're better off. But nonetheless, if the global economy slows down, there will be some impact on India's GDP growth rates, and there are differing versions. But the expectation that the growth rate will fall by 0.5 to 1 percentage points from current 6.6 or 6.5%. So it's not so bad. I mean, am I worried? I would say a little bit, but not much. I don't think it's going to impact consumer demand. And I still think that a lot of negotiations will take place before ultimately we get a clear picture in terms of import tariffs.
Harsh, the combination of household debt and then this recent drawdown in the Indian stock markets, I believe the figure was $1 trillion of market cap was wiped out. To what degree has that undermined the animal spirits in the Indian economy and amongst the Indian consumer and the wealth effect, perhaps?
So I think, the urban growth rate I mentioned earlier is much lower than rural. And I think most of the investors have invested in the capital markets are from urban centers. And they've suffered a lot. So I think because of that, there is some impact on the consumer demand because they've invested a lot of money in, especially lately over the last 3-4 years into SIP plans, which have not done well. So there is some degree of impact on the consumers who have invested in the capital markets. But nonetheless, I think the rural investors have not invested. And rural is a large part of the Indian economy. So net, I would say, even if the capital markets remain soft, there'll be some impact, but it's not going to cause a major dent in our demand.
Understood. 6.7% headline growth, nonetheless, Harsh. Do you think that is at risk given the current circumstances? And where does this leave Marico in terms of capex spending, in terms of hiring and expansion broadly? Are you putting any of that or considering putting any of that on hold, or is it business as usual for you?
No, I think by and large, at least in consumer-facing industries, business as usual. There may be some softness in terms of demand, but I don't think it's so large for us to take some dramatic decisions in terms of holding off our capital plans or not investing in our brands. So net, I think we have to wait and watch what will happen to the overall scenario in terms of the import tariffs over a period of 90 days or a little more than that. But as of today, if you ask me, are we curtailing our advertising spends? Are we curtailing our capital expenditure? The answer is no.
Harsh, RBI policy response, was that appropriate with the 25 basis point cut in the benchmark repo rate, or could they or should they have done more?
I'm not an economist, but I think it's a good sign. And I think we have to look at a trend in terms of what the signal the government is giving. Because I think the clarity in terms of what's happening internationally is fully not there. And we just need to wait and watch to get a complete picture in terms of what's ultimately going to be the import tariffs. And I reckon, and now some degree of wishful thinking is that it will be toned down to some extent, at least for other countries apart from China. So I think that will be beneficial to us.
And Harsh, if there is a bilateral trade deal, a BTA with the US, or if there is a UK trade deal, I know Finance Minister Sitharaman is in the UK and is holding those discussions with Chancellor Reeves. What would be the net impact for India and businesses like yours?
I think that will be beneficial because there are certain sectors which have got impacted, especially if you look at the import tariffs announcement, sectors like jewelry, marine exports, and some other sectors, garments. And if they are negotiated properly through a bilateral trade deal, then I think it will benefit the country. there is no direct impact on our consumption story, but because some other sectors will do well, which will ensure that employment continues in these sectors, the economy will continue to remain as currently as it is doing. So there may not be or there will be much less negative impact on the economy if such deals are signed.
Harsh, if I could ask you then, do you feel that you can, as a business, sustain revenue growth in the high teens, double-digit growth in FY26, or do we have to start managing our expectations given the risks that are on the horizon?
So I can talk about my own company. I can't talk about others, but because we have acquired a few direct-to-consumer brands, and because our international business is doing well, and we reckon that we will be able to achieve double-digit growth rates next year.
And just tell us about the international business. How diversified are you? And is that an asset or a liability given the tariff risks and just how sweeping and global it is?
Clearly an asset. About 27% of our business comes from international. But some of the countries which have got impacted, we have a big presence. So we have a big presence in Bangladesh, Vietnam, Middle East, South Africa. But let's wait and watch what happens. I don't think the consumption story may get impacted as much as a direct impact on certain sectors like garments in these countries. But there may be some impact of that in our international business, a little bit more than, I would say, the impact on the Indian business.
Understood. Harsh, if we could just wrap it up, and can you give us a line on how you see margins evolving and the outlook for Marico moving forward in the next 6 to 12 months?
We have seen a very high degree of inflation, especially in some of our raw materials, coconuts and coconut oil, which is a large part of our portfolio. And we expect that the prices will fall down, but this is an expectation. So we have to wait and watch. But there may be, depending on how the raw material prices behave, there may be some degree of pressure on the margins in the coming year. But we have to wait and watch. Net, we will manage our overall financials because I think, as I said earlier, some of the acquisitions have done very well. Our international business continues to do well. So there may be some impact, but we have to wait and watch what happens to our raw material prices.
As we all do, we have to keep a watching brief on these headlines, which seem to be changing on a daily basis and creating some historic volatility in the markets and the macro. Harsh, thank you for your time. We really appreciate it.
Thank you so much. Thank you for inviting me.
Harsh Maliwala there from Marico. Thank you. Right, let's take a look at these Asian markets, and the turnaround still going from strength to strength, and it's TAIEX, which was one of the worst hit that is now regaining its composure, up by 9.2%. Little less certainty in the mainland equity markets. On a relative basis, Shanghai Composite is up, but lagging behind regional peers, which are putting on in the magnitude of 2 to 4 or even 5 or even 8% when you look at the Nikkei 225 index. So really something of a coiled spring there for a lot of these markets. A lot depends on what happens with the US-China relationship and the fear of a retaliatory spiral there. And of course, what the next 90 days brings us in terms of the to and fro and the headlines coming out of Washington. Right, speaking of the Nikkei, Lin is watching one big mover in the Japanese markets this morning, and that is 7-Eleven operator 7 & I. And Lin, you and I have talked ad infinitum about this tussle with Alimentation Couche-Tard.
Yeah, hey Sri, indeed. And overnight we did get the earnings results for this company. Certainly that is one of the focus points. Also the commentary around the tariffs as well. Now we've seen a nice bounce for this company despite the fact that when you look at their operating profit, it saw another decline, fourth straight quarter there, decline of about 15% as well. But this is a reaction, I would say, to some of that buyback news, 600 billion yen happen by next February as well. And this is, again, an inflation story. Keeping in mind 70% of the revenue for 7-Eleven stores come from the US market, so it's absolutely crucial in its domestic market as well. Bitten by inflation, particularly along the lines of a lot of its rice-related products, given the shortage in that product as well. In terms of the tariff impact, you have management during the earnings call highlighting that there is a really high degree of uncertainty here. We know about their sort of restructure plan, and as part of that, they're looking at that IPO of that North American business. But you've got Stephen Dacus, the new CEO, Sri, saying that that could be delayed because of the heightened market volatility at the moment.
Lynn, thank you very much indeed for that. Now, before we wrap up the programme, let's take another look at how the ADRs of some of the Indian IT names performed. Both Infosys and Wipro seeing gains on that tariff U-turn. Remember, India's IT services sector highly exposed to the US markets. Shares have dropped in the double digits this year on tariff risks, and you can say the same for pharmaceuticals and the car makers. Tomorrow, we will continue talking about the services versus goods narrative. K. Krithivasan, CEO and Managing Director of TCS, joins us to talk about how the sector plans to limit tariff risks and their earnings report card. We will also track if today's rally spreads to the Indian markets when they come back online tomorrow. That's all the time we have today on Inside India. Do keep watching CNBC. Dan Murphy is up next with Access Middle East.